In this chapter, we'll explore the business function of finance, which is the planning, obtaining, and managing of the company's funds in order to accomplish its objectives. It involves meeting expenses, investing in assets, and increasing profits to shareholders. Making sure a company has adequate funds is of primary importance to a financial manager. Money is needed to buy supplies, equipment, and pay bills. The financial department of any organization is extremely important. The finance manager implements the firm's financial plan. They determine the most appropriate source of funds. Many CFOs are members of the board of directors. This slide shows what the typical finance function would look like at a company. The CFO would be at the top of the finance area, reporting directly to the CEO. Reporting directly to the CFO would be 3 senior managers. Typically, it's the controller, treasurer, and a vice president for financial management or planning. The vice president for financial management or planning is responsible for preparing financial forecasts and analyzing major investment decisions such as new products, new production facilities, and acquisitions. The treasurer is responsible for all of the company's financing activities, including cash management, tax planning and preparation, and shareholder relations. The treasurer also works on the sale of new security issues to investors. The controller, the last one we're going to look at on this chart, is the chief accounting manager. The controller's functions include keeping the company's books, preparing financial statements, and conducting internal audits. In performing their jobs, the financial manager must address the risk-return trade-off. They're looking for the optimal balance between the expected payoff from an investment, which is the return, and the investment's risk. With the risk-return trade-off, what we'll see is that if an investment is riskier, it should be offering us a higher return. Risk is the uncertainty about a gain or loss. The return is the actual gain or loss of that security in a particular period of time. Let's compare 2 investments. First, let's look at a CD from a commercial bank. The certificate of deposit offers a guaranteed interest rate. Say it's 3%. It's a short-term investment. We'll have that money and the interest out within, say, 3 months. That's very safe, but very low return. Now, if we look at a stock investment, we have a much higher level of risk. We don't know about the gain or loss. So what we should expect is that we'll also have a higher level of return. We need to be compensated for taking on that additional risk. That's the trade-off between risk and return. The finance manager puts together the financial plan. This is the document that specifies the funds a firm will need for a period of time, the timing of inflows and outflows, and the most appropriate sources and uses of funds. For instance, what funds will the firm require during the appropriate period of operations? How will it obtain those necessary funds? And when will it need more funds? As you can recall from the accounting chapters, these are some short-term assets: cash, marketable securities, accounts receivable, and inventory. If we need to fund our short-term assets, we should use a short-term source of funds. For instance, we're not going to issue stock, which is a long-term way to raise money, for inventory. Inventory is a short-term asset, a current asset, so we would use short-term financing, such as a short-term loan from the bank or using our line of credit. In addition to current assets, firms also invest in long-lived assets, long-term assets. Unlike current assets, long-lived assets are expected to produce benefits for more than 1 year. These investments often involve substantial amounts of money. The analysis of what investments need to be made and what sources of funds will pay for these long-lived assets is called capital investment analysis. Firms make 2 basic types of capital investment decisions: either expansion with new assets or replacement, upgrading our assets. There are 2 basic categories for sources of funds for our firm: either debt capital or equity capital. Debt capital represents funding through borrowing. Equity capital consists of funds provided by the firm's owners when they reinvest earnings, make additional contributions, or issue stock to investors. The mix of a firm's debt and equity capital makes up its capital structure. On the next slide, we're going to look at a comparison of debt and equity capital. One of the main differences between debt and equity capital has to do with maturity. Equity does not have a maturity date. When we issue stock, there isn't some date in the future where it has to be redeemed. With debt, there is a maturity date. A contract would specify a date that the borrower must repay the loan. There is also a difference between debt and equity regarding claim on assets, claim on income, and a right to a voice in management. Lenders have a prior claim on assets and income so that they receive their interest payments. Equity holders have claims on assets only after the firm has satisfied the claims of its lenders. Stockholders are owners in the company and therefore have a right to a voice in management. Lenders, on the other hand, are just creditors. They're not owners, so they have no voice in management. Now let's look at leverage. This is when we use borrowed money or debt to try and increase returns. The key to using leverage is making sure that our earnings are larger than the interest payments we need to make to maintain this debt. In this example, we can see the effect leverage has on returns. In the leverage corporation, we're using bonds that pay 10% interest as part of our funding structure. 90% of our corporation is funded using leverage, or debt. Only 10% is equity, or money put in by the owners. In equity corporation, we're funding with 100% equity, no debt or leverage. Under leverage corporation, we have to pay interest each year to the bondholders. That's deducted from our earnings, leaving us with a net income or profit of $21,000. In comparison, under equity corporation, we don't have to pay interest, so our net income profits are $30,000. When we look at the return to stockholders, we divide the net income by equity. We can see how using leverage can increase returns. Even though we have lower income under the leverage corporation, we have a higher return because we didn't put in as much of our own money. We only put in $10,000, giving us a total return of 210%. Under equity corporation, we're only using equity, so our return is calculated as $30,000 over our equity investment of $100,000, giving us a return to stockholders of 30%. While 30% is good, we can all agree that 210% is so much better. What we have to understand is that this use of leverage also increases our risk. Financial managers also have to think about dividend policy. Dividends are cash payments made to our shareholders. Financial managers must make decisions regarding this policy. Should we pay a dividend? How much should we pay? And when should it be paid? Financial managers also need to decide on the right mix of long-term and short-term financing. Let's start by looking at the short-term sources of funds. If you remember, short-term sources of funds are repaid within 1 year. Major sources of short-term funds include trade credit, short-term loans, and commercial paper. If we need funding for longer-term assets, we need to look at long-term financing. This would include the public sale of stocks and bonds, private placements, venture capitalists, and private equity funds. Public sales of securities such as stocks and bonds represents a major source of funds for corporations. When a small group of investors, such as a pension plan and insurance companies, privately invest in a company, it's called a private placement. Venture capitalists are an important source for new companies. They invest in promising firms. They also provide management consulting and advice. Private equity funds are investment companies that raise money from wealthy individuals and institutional investors and use those funds to make investments in companies.